2, 3, 4, 5 for the audience for the rest. Huh? I bet a lot of people will watch this one. I bet they will. Let's hope so. Seeing for sacrificing people. Okay, do you want to do them all? Do you want to do particular ones? What do you want? What could miss? That's a good way to go. What could miss when you do the test? Everything, huh? Yeah. And now you're going to wonder, that's 1 to 4. We can do quiz 1 and 2 and 3 and 4 too if you want. It's going to be on that material, right? We're talking about the quiz we're going to do next Monday for 20 minutes. Right? 20 minutes. Just a bump up to the test score. I'm not adding any points to the total points. Just give me 20 points to the grade level. And you need investor level. So, right? So, you want to do the first one? We have the non-committal. Sure. Did you test with you? Get it online? Get it online? Get that in person? Okay, good. All right, so during 2013, we're starting with the first problem. During 2013, Smart Company started operations that performed services for which customers paid or promised to pay $330,000. So they look to me like if they perform services for $330,000, they have revenues of $330,000 so far, right? Whether they collect or not doesn't matter. But this amount, 180, had not been collected by year-end. Well, that'd be account receivable, wouldn't it? And then Smart paid 110 cash for employee wages and owed the employees 9,000 at the end of the year, so that looks like 119, right? And then they had rent expense of 40. Everybody agree with that? And 125 for other expenses. Tax rate 40, income taxes have not been paid at the end of the year. So they paid dividends of 5. There were no other events. And then it wants to know what's the change in cash. Well, if we did journal entries, we got that. What's the total revenues? We did journal entries, we do that. With tax expense, if we did a T founder journal entries, we'd have that. Net income will probably be the difference between our revenues and expenses. Bring us both. Into retained earnings. It's our first year of operations. I bet it starts at 0, and then you add your net income or subtract your costs, right? And subtract your dividends. So, how about if we set this thing up like this? Variety of ways you can go. Assets equal liabilities plus equity. Test 1 through 4, number 1. Although the test I gave you, the test I actually gave you, I guess you wouldn't have it online, would you?
No, it wouldn't.
Do you have it with you?
No, I'd rather online.
I bet we'd share one. You don't have it either? You guys! I can't even call it up because it's on my computer and in my car. Yeah, so anyway. Okay. So, can you find it? Just sit with people. Sit with people who don't have it. You guys have an extra one between the two of you? You didn't have yours either? Oh, geez. Okay. Would you rather work the real one? We can work the online one if you'd rather. I don't care. They're about the same. You can do that too. Well, let's go ahead and do this problem, and then we'll maybe switch over. Okay, and so I wanted to know about contributed capital and retained earnings, obviously, because I'm asking for the ending retained earnings. So, what's beginning retained earnings is the first year of operations? 0, beginning everything 0, isn't it? Okay, so here's what they did. They said they performed services for customers that paid or promised to pay $330. Of this amount, 180 had not been collected by the end of the year. So if we took the whole year and we made it a journal entry, wouldn't that be credit sales revenue for $330? Everybody agree with that? That's $330,000 of revenues, okay? And then we debit cash for the amount that was collected. If 330 was the total and 180 was not collected, how much was collected? 150. Would everybody agree with that one? Okay. And then wouldn't you debit accounts receivable for the rest? For the 180 that was not collected. Everybody agree with that? You could do that. And then they paid 110 for employee wages and owed employees another 9. So wouldn't that be wage expense or wages and salary expense for 119,000, right? And when you credit cash for the amount you paid, 110, and then when you have wages payable, maybe salaries and wages payable for the other 9. Everybody agree with that? If you were to read something like that now, they paid 110 employee wages and owed the employees another 9. So 119 is what the employees earned, right? That's why I have wages expense. Come on, Keith. Wage expense is 119, right? And sales revenue is 330, just between those two. And then it says, Smart paid rent expense of 40 and 125 for other expense. So it'd be rent expense, 40, other expenses, whatever they are, but it's all expenses, all expense accounts, for 125. And it said they paid it, so that'd be cash, wouldn't it? Is there anything that's bothering anybody yet out of all that? That's true, isn't it? Okay. The income tax rate is 40% and taxes had not been paid at the end of the year. Okay. So what I'm going to do is I'm going to have to figure out what my tax is, right? Okay, so let's get the net income before tax. So I'd have my revenues less all the expenses, and then I'll get my net income before tax, and then I'm going to have to do what? Subtract the tax expense, and we'll make a journal entry for that too, and that'll give me my net income. So this made it a tough first problem here, okay? So what do we do with this thing? Well, let's see. The revenues right now are how much? 330. The expenses so far are how much? 119 plus 40 plus 125 is how much?
Well, plus 40 would be 324.
324? 119 plus 140 plus 125, right? 324? 119, 125, and 40.
Yeah. And, then that's 284.
284.
Yeah.
119, 40, and 125. Everybody agree? 284?
Yeah.
So then what does that leave me for net income before tax? 46 grand? Okay. And then what's the tax expense going to be? So this is 46,000. Tax expense is 40%. So what's 40% of that? 18,400. What does that leave me for net income? What's 46,000 less 18,400? I get it right. Is that 27,600? I sure hope so. Okay. All right. So my net income is 27,600. My total expenses is what? 284 plus 18,400, right? You guys agree with that? And my revenues are 330. Okay. All right. So it asked me, first thing is, what's the amount of increase or decrease in cash? Well, there's a debit increasing cash. We just do a cash T account if you want. 150 came in, right? And then 110 went out. And then 165 went out. What happened to cash? Is that everything for cash? 150 in. Oh, there's also a dividend. Come on, Keith. They paid dividends of 5,000. What would be the entry for paying dividends, everybody? Credit cash. Yeah, absolutely. And debit what? Dividends are retained earnings, right? Dividends would be a temporary retained earnings account. Good. That'd be for the 5. And then cash credit for 5. Okay, so now I've got another 5 coming out of cash, don't I? Okay? So what's the change in cash in total? I pick them all up.
30,000? No.
130.
Yeah, 130.
Okay. Net credit of 130 when you add them all up. So reduction of cash of 130 was the first answer. Okay? Decrease in cash. Make sense? Just your debits and your credits. Okay. And what's total revenues? 330, right? What's tax expense? 18,400. What's your net income? 27,600. And then it asks for ending retained earnings. Well, let's do retained earnings. What do we have in retained earnings? Starts at nothing. How much net income did you have? 27,600. How much dividends did you have? 5,000. What's the ending retained earnings? 22.6. This isn't hard anymore, is it? It was, but it's not. Funny how that works. So should we switch over to the, when you do it, does everybody have a copy of it, either online or in person? The one I gave last summer? I think I have a copy. Summer test one. You know the reason I love all this stuff. Oh, the first one was where you had to fill out that grid, right, guys? Water balances, similar to the one we just did in a way. Well, they're all friends. So let's switch gears and we'll do the summer 2013 test, the practice one. Let's try it. I'm going to start with column 1. Is that worthwhile? You can do other things if you want. I'm indifferent. Okay, so for Bellarmine Company, I gave you some information and left other information out. I suggested to you that you write down everything you know and stuff for what you don't know, right guys? Okay, so all this information relates to the balance sheet and the income statement, so I think I get it set up like a balance sheet and an income statement, just the accounting equation, right? That's a balance sheet, really. That's an income statement, isn't it? And then as you get into it, you can see that it's asking for things, I think, about contributed capital and retained earnings separately. So we'll split equity into contributed capital and retained earnings, won't we? You guys good? So I think I'd set it up like that. You don't have to, but it makes life simpler, I think. And then what I'm going to do is write down all the pieces I've got, and I've got beginning and into the year numbers. So we'll do beginning and end, huh? Okay. So retained earnings at the end is 35,000. Is that right? So let's write down 35,000 here. Everything's in even thousands, isn't it? Okay. And it's obviously not their first year of operations, right? Because they got beginning balances, some of it. Okay. Ending liabilities is 190. Is that right? Am I reading beginning and ending right, everybody? Expenses are 90 for the current year. Okay, good. I'd like to know the owner's investment. That's the credit to contributed capital. I'm looking for that one. Okay, assets at the beginning are 390. Assets at the ending are 400. Is that right? Stop me if I screw something up. I can do equity now, can you guys? 400 less 190 is 210. So this number must be 210. Got that one now. Okay. And then it says revenues are 115. I write down the revenues, and guess what? I can do the net income. What's the net income? You guys out there? That's right, isn't it? Where do you put the net income, of course? It increases retained earnings, doesn't it? Okay? So I added 25 and ended up with 35 at the end somehow. And then it says dividends are 10, is that right? Okay, so dividends come out of retained earnings. Did I write down everything they gave me? Nope. Contributed capital at the beginning was what? 90. Okay? I don't know what it is at the end, but I'd like to know how much to add to it. Okay, what else can I solve for? I already solved the ending equity and calculated that one. Everything, and I already solved the net income, which gave me this number down here. What else can I solve now? Oh, come on, something's got to give here, you guys. Yeah, beginning retained earnings. Sure, you got 35 ending, and you added 25 to it, right? And you took out 10. So how much net did you really add to it? You added 25 and took out 10, guys. You added 15, didn't you? And now it's 35. What did it start at? 20, I think, is beginning. Is that right? Any questions? Beginning. Ending. It's got to go back to 20, doesn't it, at the beginning? Now what can I do? Sure. What was the beginning retained earnings? 20. What was the beginning contributed capital? 90. What's 20 plus 90? 110 at the beginning. Everybody agree? We just solved that one. So now what can you solve? Beginning liabilities. What is that? 280. We got that one. Okay? Now what? Keep going. Must be one other thing. I need ending contributed capital, don't I? To get the addition to contributed capital. Can I get ending contributed capital? Sure I can. What do I know? Ending equity is 210. Less 35 in your retained earnings. So 210 here, less 35 here. Everybody agree with that? How much is ending contributed capital? 175. How much must contributed capital be? It was 90 and now it's 175. 85. Okay. Now you can do that before you write down any of the answers and then just take them, right? A is beginning retained earnings, isn't it? What is that? 20. B is beginning liabilities. What is it? 280. C is owner investment. What is it? 85. D is net income or loss. Net income, 25. And E is ending contributed capital, I guess? 175. Can't miss these, can you? You guys do the other one, real quick. Count through. And then we'll make sure you did it right. Which I have total confidence you will. A little more light in here, maybe. I don't know how, but if I turn this one on, ooh, it's off. If I turn that one off, this one, too bright or better? That's good? Okay. Half a little. Guess I could open blind back up and decide to quit changing that. guys getting there? It will. Set it up exactly the same way, guys, right? Balance sheet, income statement. Seeing as it's asking for this information, you probably used it, huh? Okay, we do the same process. So what do we know? Contributed capital at the beginning is 150, right? So let's write that down there at the beginning. Okay. We know net income is 60, do we? How much net income gets added to retained earnings then? 60, sure. Okay. Liabilities at the beginning are 620, so we're going to have beginning and ending. Okay. 620 at the beginning, okay? And then retained earnings is a debit or deficit balance of 20. So we must have paid out a lot of dividends, it looks like to me, huh? To make that 20 at the end. Let's see, owner's investment is 10, so that would have made it 160 at the end, I guess. Expenses are 400. And if expenses are 400 and a net income 60, what do you think? Revenues must be 460, is that right? Okay, it was net income, not net loss, yeah. Assets at the beginning are 710, correct? And at the end, 620. Okay, so can we solve anything now? Yeah, what's equity at the beginning? 90. Can you solve anything else? Beginning retained earnings. Do we know the dividends? Dividends we're looking for. I don't think you can get beginning yet because I don't know the dividends here and I don't know the beginning. True? I think I can get that yet. Keep going. What else is missing? Liabilities and equity, it looks like to me. How about ending contributed capital? That's missing too. Can you do ending contributed capital? Yeah, what's that? 150 and 10, right? That's 160. Okay, so you calculate that one. Now what can you do? Yeah, 160 less 20, right? Credit less a debit. How much is that? 140. So now we got that one. So we're doing pretty good. Now what? So for liabilities, you could. 620 less 140 is how much? 480, is that what that is? All right. What's left? Dividends and beginning retained earnings. Can you get either one? Yeah, I still want those two, don't I? Dividends and beginning retained earnings. Well, come on, you guys. What's the beginning equity? It's 90, isn't it? What's the beginning contributed capital? Yeah, 150 plus some number is 90. 60, but it's a what? Debit, they had a deficit of 60 at the beginning, and they have a deficit of 20 at the end. And they earned 60, which would have made it 120, and now they're down to 20, so what they pay in dividends? What 60 would have made it nothing, and now it's down to negative 20. What's that? 20 of dividends. That's it. Okay? So now I got my dividends. And then you go down the list, solve everything first, I think I would. Contributed capital at the end, 160. Revenues, 460. Liabilities at the end, 480. Dividends, 20. That was it, wasn't it? Did I miss anything? Oh, retained earnings at the beginning. Debit of 60. Debit of 60. Notice I don't answer any questions if I were wrong. It'll drive you crazy otherwise. You'll be trying to do one and then trying to do the next one, trying to do the next one. Just do it all. Okay. You know them all anyway. You glance at it, wow, they want to know all that stuff. Okay? Can you do these? With a little work. You're going to get this solid, aren't you? And just think about it this way. You're going to have it for the final, right? So we're kind of getting ready for the final. Here we go. Okay? Kind of was my plan from the beginning, but we'll do it this way, right? That's fine. No, it's not. Let's do number 2. What would be the effect on the financial statements of recording the purchase of a forklift for $20,000? It's just for debits and credits, right? So if we knew the journal entry, we'd know the effect of the financial statements. A down payment of $4,000 made, a 6-month note at 10% interest was assigned for the balance. Forklift has a useful life of 4 years and 4,000 salvage. Straight line is going to be used. The truck was purchased January 1st and the year end is December 31st. But this just wants to know the effect of purchasing it. So I don't care about the interest or the depreciation, do you? Not yet. Okay, maybe later. Okay, so what's the journal entry for number 2? And again, this is number 2 from the summer 2013 quiz that's on Moodle. Okay, debit equipment for 20,000. I like it. I think that increased assets by 20,000. Okay, what else do we have?
No, the cash for 4,000.
Okay, credit cash. Was it 20% down? 4,000.
4,000.
Yeah, so now I only have assets going up by 16, right? Everybody agree? And what else?
That would be note payable for 16,000.
You got it. Note payable. Now, all this question asks you to do is tell it what happened to assets, liabilities, equity, revenue, expense. What do you think? Assets went up by, careful, not by 20. Up by 20, down by 4, it'd be up by. Yeah, so assets are up by 16. You don't even have to write it in the accounting equation at this point, do you? Notes payable? This is assets. It's a liability, isn't it? Increased by 16. Everybody agree? Those are the answers. What's all the rest of it? What happened to equity? Since you didn't debit or credit an equity account or a revenue expense account. Nothing. No effect. Revenue expense does not in the entry. No effect. And therefore net income? No effect. Oh my gosh. Did you miss this one? You did. Annoying, huh? Not too bad, are they? Okay, let's try number 3. Once you know what you're doing, these things get really easy. I guess everything does. What would be the effect of the financial statements recording the payment of the note in problem number 2? Oh, this gets a little more difficult, right? How long was the note for? 6 months. So this is going to be at June 30th, right? That was at January 1st. They bought the thing. January 1st. This is at June 30th, 6 months later. We're going to pay for it, and we're going to pay 6 months interest too, aren't we? What are you paying for? The equipment, but what are we paying? We already paid 4 of it, so what's the rest we have to pay? The note payable of 16. So what do you want to do to notes payable? Of course, you're paying it off. Debit. Debit notes payable for 16. I think that's true. Okay? What else are you going to have? What's the interest rate? 10%? How long is it though? Yeah. So what are you going to do? You're going to take the $16,000 note payable times 10%, which would be $1,600 times what? 6 months, you guys. 6/12 of a year, half a year. Everybody agree with that? So how much interest is there going to be? 800 bucks, okay? So how much cash are you gonna give them if you pay them back 16,000 plus 800 interest? 16,800. Is everybody staying with me? Don't let me go too fast and lose you. Don't do that, right? Like we do every day in class, right? Review me on it, yeah. Okay, debit notes payable, credit cash, huh? What's the $800, you guys? It's interest expense. It's the expense I incurred to get the money, huh? And I use the money to buy a piece of equipment that I'm gonna earn revenue with. So all the costs associated with that piece of equipment, this time interest, is a expense, isn't it? Costs associated with getting the revenues. Interest expense. Now you tell me, what kind of accounts are these things? You already know, or you couldn't have done them, right? Notes payable, liability. Interest expense, expense. Cash, asset. So here it might be useful to do this. You don't have to, but it might help you keep you straight. Because you know it's got a balance, don't you? So every time we debit or credit revenue or expense, we're changing equity, aren't we? All right, guys? So it's going to get closed to retained earnings. So notes payable with a debit does what? Goes down by 16,000. You guys with me? The interest expense goes up by 800, right? Cash goes down by 16,800. What must have happened to equity? Down by 800. How'd that happen? No effect on retained earning or revenues rather. So therefore, what happened to net income if expense goes up? Goes down by the 800, which is what caused retained earnings and equity accounts to go down. And this asks for what would be the effect of recording it. Yeah. So those are the answers, huh? Decrease assets 16,800, decrease liabilities 16, decrease equity 800, no effect on revenues, increase expenses by 800, reducing net income of 800. Can you do it? Write down your entry, and then what's the impact? You can't do the entry unless you know what the effect is. And I know you guys can do the entry, so kind of made. Everybody good? Happy with this? Which is harder, this problem, these two problems, or the first problem? I don't know. All easy at this point, hopefully. Cumulative learning. Skill development. That's strange. Why is that in two places? How did I do that? Okay, magic. Okay. Let's do 4. What would be the effect on the year-end financial statements of failing? Okay, read carefully, right? This is failing to do it. So once we learn what the effect is, then we can just look at the opposite of that, and that's what the failure recorded would be, right? Not recorded. Okay, so it says it's the depreciation on this truck. Okay, so what's the journal entry for depreciating? That's all we need, huh? And then we'll say, what's the impact of not doing it? So what's the debit and credit for depreciation, by the way? When is it going to be first? They're doing annual statements. You bought it January 1st. When's their year end? December 31st, it says up there in number 2. So this is going to be at 12/31, isn't it? The first year. Debit what for depreciation, everybody? Yeah, depreciation expense. You guys don't really have to answer if you don't want to, but you are formulating answers every time, right? So yes. Yes. I hate you, Keith, but yes. Okay, great. All right, debit depreciation expense, credit what? Accumulated depreciation. Okay, good. All right, there we go. All right, so that's how you do it, right? Increasing the expense account, which reduces net income, which reduces equity. Yeah. And then it's crediting accumulated depreciation, which is a contra asset, which reduces assets, right? Okay, how much? What's the cost of that piece of equipment? This time it's not the 16,000 notes payable, it's the whole 20,000. What kind of depreciation are we going to use? Straight line, but we have a salvage value, don't we? You better take your salvage value out first, your residual value. How much was that? 4,000. So it is 16,000. Way to go, Keith. I shouldn't have done that. Somebody make a mistake and get it right, huh? Okay, anyway, so my depreciable value is 16,000. It's obviously the cost, that's the salvage value. What's the life? And it's straight line, right? It's that's all we knew by then. 4 years? So what's the depreciation expense each year? And it's a full year, right? It's not a part year, so it's a whole year. So guess what the debit to depreciation expense is? 4,000. What's the credit to accumulated depreciation, of course? 4,000. What if you did record that? They didn't, but if they did, what would be the effect on balance sheet and income statement? You can do this, can't you? Let's practice a little. Kind of working out well in a way. You got a week with me out of here. Get geared up for this. Assets do what? Decrease by 4. Liabilities? I don't see a liability there. No effect. What does equity have to be? It's got to go the same direction. Decrease by 4. Revenues? I don't see one. No effect. Net expenses? It's going to go up by 4 if you debit an expense, right? And net income, therefore, down by 4, which is what caused the 4 reduction of equity. Now, that's what it would do. This asks what would happen if you failed to do it. If you fail to reduce your assets, what's wrong with them? No effect on liabilities. Equity must be also overstated. No effect on revenues, expenses. Understated, causing the net income to be overstated, which is what caused the equity to be overstated. Good? Okay, has it been a while since you guys did number 5? Do you have a blank one in front of you? Or do you have, well, even if you have your answers, if you got them right, it's okay if you got them wrong. Why don't you try doing, just try doing them for a while. Let's see how far you get. And then do the ones you can do. The ones that you can't figure out, skip it, and we'll come back, okay? And see how quickly you can do these. I gave you 30 points on the test here, so, you know, I guess 1/20th of that, I don't know. No. If I gave you a problem like this, that might be the whole quiz, huh? Something like that. If I did. Take all the fun out of it for everybody, like what you said. Right? the source. B is the source. D you could do. F you could do. H you could do. K you could do. M's easy. Then go back and do all the adjusting. got it? See what happens. You guys do for A, issue stock to a new stockholder for cash. This is nice, huh? What'd you get? Debit cash, 10,000. Got cash, asset, morbid, credit, common stock, capital stock, something, right? That time probably capital stock, you call it common stock probably, huh? There'd probably be common stock, additional paid capital, common stock really, but yeah, something like that. Okay, good. That's what that one would be. Received 12 months rent in advance. What do we get? Cash debit. How much? It's for 12 months. We're going to earn $3,000 a month, right? Yeah. Okay, and credit what? We haven't earned it yet. So they have a prepaid. What do we have? We received it. Unearned rent revenue. Unearned rent revenue, which is a what? Liability. Everybody knows that, right? You don't have to put the L down, but just so remember. It's a liability in it, okay? And then I'm going to earn the liability by letting them use the property. Is that right? Whatever I'm renting, warehouse, I guess. So at February 28th, they say, and that was January 31st, so February 28th, 1 month later, C, right? They have earned 1 month of the rent. So do you owe them one less month rent or what? Like you owe them one less month, don't you? So how would you reduce the amount you owed them? Debit unearned rent revenue, right? Everybody agree with that? Because you owe them now 3,000 less. You only owe them 3 months, or I'm sorry, 11 months of 3,000 a year. So 36 less, 11 months of 3,000 a month. You owe them 33,000. So 36 less 3 is 33,000. Works out good, doesn't it? Every month we're going to make that entry, debiting under rent revenue. And because we've earned it, what is it now? Rent revenue. Yeah. You guys can do this, can't you? That's an adjusting journal entry. B was a source entry, A is a source entry, C is an adjusting journal entry. Okay? All right, let's try D. It says February 20th paid management salaries for March. I'm paying it in February. What did I pay it with? Cash, so let's credit cash for 80,000. Is that what it was? What do you want to debit? It's not an expense yet. What is it? Because I haven't used it yet. What is it? I heard you saying that. That's exactly right. That's prepaid salaries. It is, isn't it? Which is an asset. Okay? And then the next month, any entry necessary for that. Well, they earned it now. You used it up. What did it become? An expense. Prepaid's gone, the asset's gone, and now you have an expense. What do you want to call the expense? Probably seeing as salaries. How about salaries expense? And what do you want to credit? What'd you use up? The prepaid's gone, huh? Can you guys do these? Practice a little bit, you're going to do them in your sleep, basically. It's just not a big deal. Okay, that was E. Okay, F is just like one of the earlier problems. Purchase a computer for 12, pay 3,000 down, sign a note for the remainder. It's got 15% interest due May 31st, 2008. And it shouldn't have been 8, it should have been sometime in the future, sorry. The first one was 12. The computer has a 3-year useful life, no salvage, it will be depreciated on a straight line basis. Okay, so what do you want to do with that one? What do we get? Computer, so you can debit computer or equipment or office equipment or something like that. How much are we going to pay in total for it? 12. It's an asset, I have more, I debit it. Credit what? And And then later, I'm going to have to depreciate the computer, and I'm going to have to record the interest on the note, aren't I? Right? It's like earlier problems. Okay, record anything necessary on April 30th. So this was April 1st. 1 month later, okay, April 30th. What do I have to do? Well, what are you going to have to do on the if you're doing monthly financial statements on the computer? Depreciate it, right? Okay. So if we assume what it was, a straight line. No salvage or salvage left? No salvage. So how much are we going to depreciate? 12,000. How many years is this thing going to last? 3-year life. What's that? 36 months? So $12,000 cost of it. All right? Everybody staying with me? That's the computer. Divide it by 3 years times 12 months. 36 months? What is that per month? That's it. Right? Very good. What do you want to debit? Depreciation expense. Okay, this is at April 30th. It's just for 30 days, right? That's the point. For 333.33. And credit what? Accumulated depreciation, because we're depreciating, right? That's how we do it. Okay, we got that one. And then what about the debt? They have interest, right? How much interest? It's $9,000 a year, 15%. But how many months do we have? Just one? 1/12. So what's 15% of 9,000? 1,350? 1,350, and then divide that by 12, what'd you get? 112.50. Okay. That's it. So what do I have? Time went by. It's a cost of having the equipment. So what's that? Just like the depreciation expense, except this is the interest, huh? Interest expense, cost of incurred, used up. Credit what? They didn't pay them. Interest payable. Okay. You can't memorize these, can you? You just have to figure out what happened and report it. Okay? Well, maybe you can memorize them. I don't have that big a memory. Okay, let's see on H. Purchased and paid for supplies of 4,000, put in the storeroom. So what do you want to do with that? Debit supplies inventory, probably. Okay, so now we're down to, that was G, this is H. Debit supplies, and I'd say inventory, because there's supplies expense and supplies inventory. They're different, obviously. $4,000. And credit what? Paid for them. Cash. What if I didn't pay for them? Accounts payable. Sure. Okay. And then it says at the beginning of the month there were 1,000 on hand, and then at May 31st it says at hand is 500. Prepare the entry. So this was at May 1st. So in I want to do May 31st. So what I think I'd do is look at my supplies inventory and say, okay, I started with 1,000, it says, right? I just added 4,000 to it. That made 5,000 be on hand. Everybody agree? So 1,000 by 4,000, you got 5,000. At the end, they went and counted it and costed it out, and there's only 500. How much is gone? 4,500. So that's going to be what? Credit supplies inventory. Everybody agree? This is what you did. 4,500. And debit what? If I used them up, they became what? Well, yeah, but supplies you don't sell. So it's not merchandise inventory I'm selling. Supplies you use. Things I used are called expenses. Cost of goods sold, something I use to get my sale too. So it's an expense named cost of goods sold. But that's merchandise inventory. This is supplies inventory. So what do you want to call this? How about supplies expense? Okay, more likely. Unless I'm in business selling supplies, I guess, then it's, I would call it merchandise inventory still, probably. Right? So supplies expense. Okay? Everybody doing good? Are you doing good on this? Everything's all right? You doing? Yeah? Pretty good? Better than the first time by a long ways? Okay, and then May 31st, 2012, I guess that's when I wanted the computer debt to be due, huh? Yeah, it was supposed to be May 31st, 2012. Way to go, Keith. Okay, so assuming that's what I meant, which I guess it was, I'm going to pay off that debt. Now, this is going to be a little strange, isn't it? This one gets tough. On J, what do we have? Is that a J? No. It's an I to me. Okay. On J, what are we going to have? What do we have in the account? I have note payable with how much in it? How much should we borrow? How much should we borrow? You guys remember? 9,000 was it? Okay. What do I have in interest payable? I got that too, don't I? 112.50. Okay, so I've got those two accounts, don't I? Okay, I'm paying those off. And then I'm also gonna pay interest for the rest of the term, right? This is at May 31st. So how long have I had the money borrowed? Just 2 months. It's only a 2-month loan, I guess. So it's 2 months. So how much will be the interest for the second month? It was $112.50 for the first month. $112.50, I guess, unless there's interest on the interest, but let's assume there's not, I guess. Okay, so what would we do then on that one? How much cash am I gonna pay out? Yeah, 9,000 plus 112.50 for April's interest plus 112.50 for May's, right, guys? 112.50 each month. Is everybody staying with me on that? So that's 225. 9,225, is it? How much note payable are you paying off? Yeah, $9,000. How much interest payable are you paying off? 112.50, right? That was last month. What do I need? Another 112.50 for this month. What's that going to be called? I incurred the cost this month. Yes, interest expense. That was good. Especially the point we were then. Easier now, huh? But still makes you think of it. Okay. Okay. K. Provided consulting services to client totaling $10,000 and receiving $7,000 in cash. This is the reason why you hang in there and keep doing them, even though they felt like they were getting real hard. J was tough. This one's easy. What do we have? I got cash of $7,000. What do you want to do? Go to cash. I earned $10,000 of revenue. What do you want to credit? Consulting revenue. Credit. Consulting revenue, 10,000, right? And you're right, I have an account receivable for the difference. What is it? 3,000 debit. That's it. Okay? Everybody good now? Okay, that one was easy. Okay, cool. L, receive payment in full for that one. What do you think? What do they give me? Cash, how much? And what don't I have anymore? The account receivable. Remember when these were hard? Okay. All right, and then on M, signed a contract, but I did nothing. What do you want to do? No interest. Hope I do something like that, huh? If you don't see it on this quiz, you'll see it on the guarantee or something like that. Okay? Everybody's happy. Moderately happy. Okay. And then 6, 7, 8, and 9 related to each one of these entries, didn't they? Okay? And then really 10 is just what kind of account they are. I bet you're good at that. And prepare a balance sheet and income statement. There's a bunch of problems to do that, right? See, thanks for coming. Let's try 6, 7, 8, and 9 now. Those are pretty hard. Number 6 is, what would be the effect on the financial statements of recording the issuance of the capital stock? So let's go back to the capital stock issuance, and let's talk about what's the effect of doing it. What's the effect of A? Whoops. What's the effect of A up here? See ya. What do you think? I want to know assets, liabilities, equity, revenue, expense, net income. This is too easy to believe once you have the entry.
Increase assets by 10,000.
Yeah, it looks to me like you increased assets by 10, and
No effect on liability.
no effect, and
Decreased equity.
what, decrease? Increase, credit. It's got to be the same on both sides too, right? Increase assets, increase equity. What about revenue and expense, of course? Seeing as there's no revenue expense account in the journal entry. No effect. I mean, you just can't miss these, you guys. And net income, of course, no effect too. Right? There's no effect on revenue or expenses. Okay, let's see. The adjusting entry for management salaries. So that was this one in E, down here, right? What's the impact of that thing, you guys? What'd you do? Assets equal liabilities. You don't have to write these down unless you just want to. If you get the right answers without writing them down, great. If it helps to write them down, do it. I think. What does a debit to salary expense do? Yeah, that's what you were doing by the 80,000. What does a credit to prepaid salaries do? Prepaid salaries. Prepaid asset. Okay. That's it, isn't it? What happened to revenues? No effect. You didn't do a debit or a credit. What happened to net income? Went down by 80 if you increased your expenses, right? What happened to equity? Went down by 80 because you reduced your net income, which you reduced your retained earnings, right? And they have to be the same on both sides. What about liabilities? No effect. There's no debit or credit to the account, and you got it. You got it. It said, what would be the effect of recording it on those first two? Yeah. And then on 8 and 9, it's failing to record it, so it's going to be the opposite effect, right? Okay, opposite, whatever the journal is. Okay, so let's take a look at 8. What would be the effect on the month-end financial statements of failing to record the adjusting entry for the supplies in Part I? Okay, let's find supplies. There it is. What's the effect of not doing that? Not debiting supplies, right? And not crediting inventory. What would that do?
Expenses would be understated.
Yeah, expenses would be understated. And
Assets would be overstated.
yeah. And then what would that do to everything else? Liabilities, no effect.
Equity would be overstated.
Yeah, if you understate your expense, that would overstate your income, which would overstate your equity. That's right. And revenues, no effect. So if you need to, or it just makes you feel more confident, big deal. Let's do this. Write it down like this. I don't think it's a bad idea. And you got all of it right. You're fine. You can think about it without writing them down. That's great. It doesn't matter. Who cares? Okay, supplies expense goes up with the entry, right? 4,500. Supplies inventory goes down with the entry, 4,500. That's going to revenue, no effect. That's going to make net income do what? Down, which makes equity go down. And then and liabilities are going to be what, guys? No effect. And so therefore, if you fail to reduce assets, they would be overstated, no effect on liabilities. If you fail to reduce equity, it would be overstated, no effect on revenues. If you fail to increase assets, or I'm sorry, expenses, understated, and if you fail to reduce net income, overstated, which causes the overstatement in equity, right? Just exactly what you did in your head. Not bad? Okay. And then number 9 wants to know for K, failing to record the journal entry for providing consulting services to clients in K. So if we failed to record this one, what does that do? These are both assets, aren't they? Right? So assets equal liabilities plus equity, revenues less expenses, net income. I'd failed to record a debit. What's that? Understate assets, right? Revenue. If I fail to record a credit, understated. What that would do what to net income? Understate your revenues would understate your net income, which would do what to equity? Understated. Yeah, you got it. Okay, so assets would be, they need to be increased by 10, right? Equity needs to be increased by 10. Liabilities, liabilities no effect. Revenues, need to be increased by 10. Expenses, no effect. That would make net income be increased by 10, which of course is what causes the equity to be increased by 10, right? If you fail to record it, this would be understated because it needs to be higher, no effect. Understated because it needs to be higher. Understated because it needs to be higher, no effect. And understated because it needs to be higher. Wow. Boom, boom, boom. Practice with all these entries. What would they do? Right? With any one. So you sick of this test? What else would you like to put? You want to do number, maybe you ought to do real quick number 10. Let's make sure everybody gets it right. What's the type of account? And then do the type, and then say whether it's an increase with a debit or credit. Do increase. Debit or credit. Does that change the problem? So tell me what kind of an account it is. Okay? And do you increase or decrease it? Or what do you increase it with? What do you increase it with? This is on number 10. This test. That was not bad. I got them all? It's basically asking if it goes in the balance sheet or income statement, right? So then you could do a balance sheet and income statement with maybe dollar amounts. So accumulated depreciation is what kind of an account? And it's a contrast, right? Normal balance. Credit, therefore, increase it with a credit, right? Contributed capital. It's common stock, preferred stock, additional paid-in capital, and equity, increase it with a credit. Okay. Cost of goods sold. Expense, increase it with a debit. Okay. Income tax expense. Expense, increase it with a debit. Interest expense, every expense. It's an expense, increase it with a debit. Interest payable. Liability, increase it with a credit. Salary payable. Payable, it's another liability, increase it with a credit. Okay. Oh, I skipped prepaid interest. Asset, increase it with a debit. Salary payable. Liability, increase it with a credit. Unearned rent revenue, right? Liability, increase it with a credit. Good. Inventory. Asset, increase it with a debit. Accounts payable. Liability, increase it with a credit. Land. Asset, increase it with a debit. Rent receivable. Asset, increase it with a debit. Income tax payable. Liability, increase it with a credit. Building. Asset, increase it with a debit. Wage expense. Expense, increase it with a debit. Accounts receivable and equipment both. Assets, increase them with debit. Could you put together a statement like on number 11? Balance sheet and income statement. Which accounts go where? Which are current assets, which are non-current assets. Current, less than a year. Non-current, more than a year. I guess. Yeah. This one. I found the test that I believe you guys. Number 4, where these guys started a corporation and they want you to put all the journal entries on the books and then total up what the balance sheet looks like, assets, liabilities, and equity. Let me give you each of these entries and you try to record them, okay? I'll read it to you. I know most of you don't have this problem, but let's try this one. I get some more time. Number 4 here said, this is 4 on the test we did in the class. Chapter 1 to 4. Jed, Jody, and Jake organized the 3J Corporation on January 1st, 2014. Each of these owners invested $60,000 cash. It's 3 of us, so it's $180,000, right? Below are selected transactions. Give their entries on their books for each transaction. Sold stock to the owners. What do you think that is? Debit what? Credit what? Sold stock to the owners. And then we're going to keep track of this. What I want you to do is I want you to figure out what your balance sheet is in total, right? Sold to stock owners. So just write down your journal entry. Debit what? Credit what? Sold stock to the owners. Yeah. And it was 60,000 times 3 of them, so 180. Okay. Everybody do that entry. Purchased inventory for 20,000 cash. What I get, what I give up. 20,000 cash, purchased inventory. And at that point, we'd be using a perpetual system. You didn't know that. Periodic. Okay. You ready for the third one? Purchased equipment for 80,000, signed a note payable for 60, the remainder paid in cash. $80,000 piece of equipment, 60 notes payable, the rest cash. Okay. Ready for the next one? Received 15,000 from credit customers. Credit customers paid you 15,000. Okay. Then we purchased a truck for 30,000 cash. Purchased the truck for 30,000 cash. And then the last one's the hardest one. Sold inventory that cost $1,000 to a customer for $1,800. Sold inventory that cost $1,000 to a customer for $1,800, and I guess it's for cash. So it's safe. Assume it was for cash. 2 entries for that one, right? Sold it for $1,800 and it cost me $1,000. Okay? And then tell me what the effect is of all these transactions on assets, liabilities, and equity. And what I do is a key account for assets, liabilities, and equity, and you plug them in there. Now, there's also a revenue and expense, but remember that's a subset of equity, so you figure out what happened to that and put it into equity, and you got it. Or put it directly into equity. So I do 3 key accounts and then add up all your transactions and see what you get. Getting there? And of course, then your assets will equal your liabilities plus equity, your debt equal your credit, right? Not to post all your transactions into this 3. You ready, guys? You good? Let's do the entries real quick. Sold stock to the owners, what would it be? Debit what? Cash, how much? 180? Credit? Common stock, capital stock, 180, equity. Purchase inventory for 20,000 cash, what'd you get? You gave up. Get out of that. Purchase equipment for $60,000 note payable, I got. Equipment. I gave up. And note payable for the rest, 60, okay, good. Received 15,000 from credit customers, what would that be? Debit. Credit. Let me see. Okay, purchased a truck for 30,000 cash, what did I get? Trucks or equipment? 4. Gave up. Okay, and then sold inventory for 1,000, it cost me 1,800. Whoops, for 1,800, it cost me 1,000. So what would be the 1,800? Debit what? Assuming a cash sale, could be a credit sale, accounts receivable, I didn't say that. So 1,800 and credit what? Yeah, that's true. Yeah. Cost of goods sold, good. Cost of goods sold is 1,000. And what's the cash? That's the, so I sold it for. Sales. Sales revenue. Good, it's 2 entries. Right? So what's my gross profit? Sales revenue 1,800 less cost of goods sold 1,000. My net income right now is 800, right? From all these transactions. But that's more equity, right? Everybody agree with that? So, okay, so let's do it. Assets, liabilities, and equity. And all you got to do is put them in here. Cash, debit 180. It's an asset. Common stock, equity, credit 180. You guys with me? Inventory, debit 20. But that's cash, credit 20. No impact. Remember, all right? Equipment 80. Cash 20. Notes payable though 60, right? Cash 15. Accounts receivable 15. No impact of that one. Trucks 30. Cash 30. No impact of that one, right? That's good. Then cash 1,800. So I'll say 1.8. Okay. Set and inventory is 1 less. That's true. And then what? Sales increases equity by 1.8 because revenue would increase equity, right? You put it in a revenue account if you want, but you're just going to put net income into equity. Okay? Cost of goods sold does what? Reduces equity by 1.0, doesn't it? Okay? So where am I at in all this? I think that was 60. I can do it. This one's 180.8. Is that right? Did this one come up to 40.8, I hope? 180 plus 60 is 240 plus 0.8. Yeah, it's 240.8. Brilliant. Relax and do it. Should we do a couple more adjusting entries, or have you guys had enough? Do a couple? You got them? Good. Got it figured out. There's some good ones on number 6 that you study in your own from this test. Yeah. Okay. Thanks for coming. See you. Should we bag it? Is that enough? Are you brain dead? You guys look like you're brain dead. Act like you're brain dead. Everybody's happy? Unhappy? Any questions about anything? Just crank on it. Right? Practice and then relax. Sounds like we're some kind of a sports team. Practice and relax. Okay. Oh, you did an hour and a half. That's pretty good. Hi, folks at home. Study hard. Bye.